Hello guys, this week we're going to talk about topic 9, mergers, corporate control and governance. So basically, we'll briefly talk about merger acquisition because this is not a MA class, so we'll just briefly talk about the merger acquisition as well as corporate governance. And so this is for next week, but depending on our progress, I'll see whether we'll talk about option valuation in the week after next week. And for the week before the last week, we are probably I'm gonna do a revision. So just to briefly, I'll talk about how the exam is gonna go. Right, we're gonna do a take-home exam, and we're gonna talk about. I'll try to specify what kind of materials, what kind of content will be covering in the final exam. So let's first go on and start and talk about merger acquisition. So there are some recent MA cases in 2019. I mean, in the corporate finance world, and merger acquisition is a very important topic because it is usually the the kind of the biggest transaction, right? Usually, among the biggest transactions company can have, right? Because we are talking about here, one company buying another company, right? Not just buying some assets, but buying another company. So, for example, last year we have the acquisition of Bristol Myers Squibb of Celgene, right, which costs 74 billion. Takeda acquired Share, and Sanofi and Novartis both acquire company in the 10 million range. This is in the pharmaceutical industry. Now, for the media and the telecom industry, we see a deal between Sprint and T-Mobile. Sprint and T-Mobile, they are the two wireless providers in US. And that transaction cost 26 billion. And the second transaction is the transaction between AT&T and Time Warner, which costs 85 billion, right? And finally, again, this is also a very big deal because AT&T and Time Warner, they're both big company. AT&T is a very big wireless provider in US. Time Warner, we all know Time Warner browser company, Time Warner Media, right? So it's also a very big media company. And also Disney at 21st Century Fox, right? It's also a big deal, which costs 71 billion. Finally, in the computer software industry or business service industry, we see a transaction done by IBM. IBM acquired Red Hat, which costs 34 billion, and Salesforce acquired Tableau, which costs 16 billion. Yep. So basically, when we talk about merger, there's a process, right? A merger, it's a process. I mean, we see in the public that there is a date where both acquirers and targets they uh, announce the deal, right? But the whole process started way before the merger announcement. There is a approximately 1 year negotiation period before the two companies publicly announced the deal. And after they announced the deal, there's also on average 1 or 2 years for the two companies to integrate to complete the deal. Right? So both of them, it's a pretty lengthy process in terms of merger acquisition. So we tend to think a merger has two parts of the process. The first part of the process is the private takeover process. It's private because they don't announce to the public that we are talking to a bidder, right? So it's it's the private negotiation or private kind of transaction process that is not disclosed to the public. No? So it started with deal initiation, right? So it could be initiated by the target, could be initiated by the acquirer, or could be initiated by a third party, right? So a third party means that a company that is not target and also not acquired. And after, I mean, the deal is initiated, then the potential bidder or bidders will conduct due diligence process, right? I mean, sometimes there could be multiple bidders. Sometimes there could be just one bidder privately negotiating with another one, right? And then after the due diligence process, where the acquirer usually gets access to the confidential information of the target, for example, the confidential financial information, confidential technology information, right? And then they'll submit preliminary indications of interest, right? For example, it could be a range. So the acquirer could submit a indications of interest ranging from, let's say, 64 to $70, right? Conditional on the current stock price of the target, it's about, let's say, $68. And then during the process, they will also sign confidentiality agreement, which restricts the acquirer's ability or restricts acquirer's um, uh, permission to kind of use that information for other purposes, right? Or disclose that information to other parties. And then when the process goes on, I mean, there are bidders who are not satisfied with the target, who are not able to meet the criteria target proposed. So there may be bidders dropping out of the process, right? And then more serious bidders, they submit bids, formal bids, and they negotiate with the target management. And there will be a final bidder who actually won this process, won the bidding process, for example, won a bidding contest. And then this bidder and the target, they will further negotiate or settle down the specific details of the merger agreement, right? And they'll draft the merger agreement and publicly announce the deal. So then when they announce it, it goes into the public takeover process, right? And the public takeover process continues till the deal is complete, right? So here's one example. You can take a look. Let me check. So in this merger acquisition uh, agreement, so this is a merger between Time Warner and AT&T. So you could find the background transaction, which documents the specific developments from the very beginning of deal initiation to public announcement of the deal. So you can learn about the details in the merger process a lot from reading this background transaction. Usually, now let's move on to why do we do mergers, right? Mergers, we'll talk about the motives doing merger, right? And that's like the economic fundamental motives of doing merger. It also could be dubious motives, right? So kind of not very fundamental motives, but people, I mean, acquirers do that as well. And also we'll talk about benefits and costs. Let's say the synergy of the merger. And also we'll talk about mechanics, we'll talk about takeover battles and tactics. Finally, we'll talk about mergers and economy. So in general, the merger acquisition has three kinds. The first one is horizontal merger, right? So this is the one that takes place between two firms in the same line of business, right? Or offer the same products. The second type is called vertical merger. So a vertical merger involves companies at different stages of production, right? For example, the buyer expands backward the source of materials, right? So for example, the buyer buys a supplier. Right? For example, McDonald's buys a meat producer. Right? And there's also could be a forward vertical merger. That is, the supplier buys the ultimate consumer. Okay? And the third type is called conglomerate merger. Right? Conglomerate merger involves company in unrelated line of businesses. Right? So, and I mean that's just one way for, like, the big companies to step into new areas. Right? This is like conglomerate merger. So some examples of horizontal merger. For example, the merger between Exxon and Mobil. But that was a long time ago, right? I mean, we know now that ExxonMobil is a single company, but historically, they were separate two companies. They obviously they operate in the same industry, like oil industry. Huh? And also, for example, the Facebook and Instagram merger in 2012, the Disney and 20th Century Fox merger that we just talked about. There's also examples of vertical merger. For example, Google's vertical acquisition of Android, Live Nation's acquisition of Ticketmaster. Right? So Ticketmaster is a company that sells tickets for concerts, right? The Live Nation, it's an event organizer. Right? So that's why they're vertical partners because typically the ticket company, right? So how are they gonna sell concert tickets? How are they gonna sell live house tickets, right? They get the tickets, they get an event from the event organizer company, right? And also the acquisition of deal of EMC, right? And also AT&T and Time Warner. So basically the idea why AT&T, the acquisition between AT&T and Time Warner, it's a vertical acquisition is because Time Warner is usually producing content, right? And AT&T is usually providing cable TV services, right? Providing media services, right? Providing telecom services, right? Now, in order for the content to be distributed, Time Warner can rely on AT&T's channel, right? Rely on AT&T's cable TV services to distribute its premium content, right? So that's why it's a vertical merger. And now let's move on to source of synergy, right? So what are synergy? Synergy is basically the net benefits of a merger to the combined company. So in other words, it's 1 + 1 bigger than 2. Right? So many mergers are intended to reduce costs and achieve economies of scale. For example, when Duke Energy and Process Energy announced the plans to merge, the savings were estimated to be as high as 1.6 billion over 5 years. Well, this is significant cost savings. And the management anticipated that a merger would allow the two companies to reduce fuel costs and improve dispatch of electricity. These are two energy companies. Right? And achieving this economic scale is the natural goal of horizontal merger. The basic idea is that when you are producing similar products, right? Now, the bigger the production scale, the bigger the scale of the production, the lower the average cost, right? That's the basic idea. And another example is when T-Mobile acquired Sprint, right? These are all wireless provider. So T-Mobile is American wireless network operator. It is also the third largest wireless carrier in the United States, right? On the other hand, Sprint Corporation, it used to be the fourth largest mobile network in the US. If you live in the US, you will know you know all these companies well. Because when you use your cell phone, that's usually the service provider. And from this merger, the cost synergy stemming from this merger are expected to be significant, coming in at about 6 billion per year within 4 years, right? And there's also significant scope for meaningful revenue synergy as well. For example, the joint entity will have a deep spectrum position, which allows it to enter other areas with minimal incremental spending, right? So this is allow the two companies to create new products, to introduce new products, right? And what are the cost savings here? The cost savings here, the first biggest part is the network related savings, right? For example, operating a wireless network entails significant fixed costs relating to capital expenditure, as well as operating expenses such as switch and sales side costs that include rent, network access costs, and maintenance. There's also annual network related cost saving, right? So because if they're two separate companies, they have to, even if they operate in the same area, they have to maintain two kind of networks. But now they're the same company, then you can combine those networks, right? So reduce the maintenance cost. There are also significant SG&A savings, right? The combined entity to expect to see synergy relating to sales, service, and marketing of roughly 1 billion. There's also back office related saving, which include IT billing back office costs, which are coming at 1 billion. Right? So this is sales general administration savings. Right? And vertical integration. So vertical mergers, they seek to gain control over the production process. Like we just said, rather expanding backward toward the output of the raw material or forward to the ultimate consumer. So it could be a forward vertical merger, could be a backward forward merger. A backward vertical merger. One way to achieve this is to merge with a supplier or customer. And the purpose of doing vertical integration or vertical acquisition is to facilitate the coordination and administration. Right? Because when you try to do business with your supplier or customer, right, you guys have to coordinate on schedule, coordinate on the agreed upon price, right? Now, if you acquire your supplier, that kind of coordinated process will become much easier. Well, for example, if you have an airline that does not own any planes but rents planes, right? And this strategy might work on a small scale, but it will be very difficult to implement for large companies, right? And all major airlines have integrated backwards away from the consumer by buying and flying airplanes. Right? This is kind of idea. And another example is the acquisition between AT&T and Time Warner. So AT&T is the world's largest telecommunication company and the largest provider of mobile phone services and the largest provider of fixed telephone services. And Time Warner, we all know it's American multinational mass media entertainment conglomerate. It produces content. And on October 26, 2016, both companies, they announced that they have entered into a definitive agreement under which AT&T will acquire Time Warner in a stock and a cash transaction value at 107.5 per share. So the deal basically combines Time Warner's content and the ability to create a new premium content, connect with audiences around the world, right? With AT&T's extensive customer relationships, right? And also combines it with AT&T's largest paid TV subscriber basis and the leading scale in TV, mobile, and broadband distribution. And the CEOs of these two companies, they talk about this deal and say that this is a perfect match of two companies with complementary strengths. Right? So because one has the cable TV services to try to deliver the content, the other has the content, right? So these complementary strengths can bring a fresh approach to how the media and the communications industry works for customers, content creators, distributors, and advertisers, right? And they all claim that we'll have the best premium content with the networks to deliver it to every screen. Right? Now, a central problem for vertically related firms is the holder problem. That's a very famous problem, right? And that essentially says that the parties to a future transaction must make non-contractable relation-specific investments, right, before the transaction takes place. And the specific form of the optimal transaction, right, such as quality level specification, time of delivery, and what quantity of units, right, they cannot be determined with certainty beforehand. Right? For example, suppose the automaker needs crankshafts as an input for making engines, right? The crankshafts are very specialized input designed for use by that particular automobile manufacturer. And it requires an investment, specialized investment, right? It requires a very specialized investment. It is specialized in the sense of this investment is particularly for this particular automaker or for this particular consumer, right? If you produce this input and finally it's not sold to this consumer, then it is worthless, right? Nobody will want it. That's why it's a specialized investment, right? Specialized in the sense of this investment specifically committed to this relationship. If the crankshaft manufacturer does not sell the crankshaft to the automaker, right? Just like I said, the automaker's investment continuing engine production will be worthless, right? And similarly, I mean, if the automobile manufacturer does not buy the crankshafts, the supply's investment will be wasted. Right? Now, this is the relation-specific exchange, right, or investment, right? This gives each firm a potential incentive to engage in opportunistic behavior, right? Because they know that, I mean, if the other party cannot cannot sell the products or sell the input to them, right? Then the other party is screwed, right? So that's why they can engage in opportunistic behavior, right? So, for example, once the supplier has invested in the equipment to make crankships, right? Then the automaker can attempt to capitalize on the sunken nature of this investment by asking for a lower price. Right? So, because this is already kind of done deal, right? On the other hand, once the automaker reaches the stage of production where it must have crankshafts to finish the cars, then the crankshaft supplier may ask for a high price, right? So that happens on the other hand as well. Right? So that's why for both parties, there could be opportunistic behavior from the other side. And the outcome here is that the two parties spend a considerable time negotiating over precisely how much will be paid for the crankshafts. So this lengthy negotiation process to make sure that opportunistic behavior does not happen increases the transaction cost of acquiring the input. In general, production of components may require large investments, highly specialized equipment. Right? For example, a smelter might need to be located next to the mine to reduce the cost of transporting the ore. Right? And also, in general, long-term contracts are difficult to execute and incomplete. Right? So that's why MA seems to be the way out, right? Because if you acquire a supplier, right? If your supplier becomes part of you, then this negotiation process is not that painful, right? Because it's just one of the division, right? How can you expect there will be conflict of interest? Or with a division manager, right? You just call the division manager, so then it will be settled, right? Because in that case, there will be a centralized department like the company senior managers. They will coordinate the production process, right? Which is more efficient and more quickly, right? So this is the argument for why we want a vertical integration. But nowadays, this kind of trend seems to be flowing out, right? Because companies are kind of starting to find it more efficient to outsource the provision of many services and various types of production. They find it cheap or they find it more efficient to outsource the production of the inputs. The reason is that outside suppliers, they tend to use non-union labor at lower wages, right? But if you acquire another company and produce it within your firm, you have to offer a higher wage. This wage cost, right, is against the potential benefits the vertical integration can bring, right? So that's the idea. And there's also the synergy brought out by the complementary resources, right? For example, many small firms are acquired by large ones, right? Small firm might have a unique product, but lack the engineering and the sales organization to produce and market it on a larger scale. So the two firms have complementary resources, and the merger may open up opportunities that neither firm would pursue out otherwise, right? For example, many of the major pharmaceutical firms have faced the loss of patent protection, right? And this is the incentive why there is increasing number of acquisition biotech firms, right? Because big firms, they have power to protect the patents, right? Because they have patent attorneys, they can afford patent attorneys, right? For smaller firms, they cannot afford it. And this was the incentive for 2014, the pharma mergers. Also surplus funds, right? So firms in a mature industry, they might have excessive cash, but fewer profitable investment opportunity, right? So in that case, managers seek mergers financed by cash as a way of redeploying their capital, right? So such firms often find themselves targeted for takeovers by other firms that propose to redeploy the cash for them. Right? Now, also eliminating efficiency, right? So for example, some firms might have an exploited opportunity to cut the costs and increase sales and earnings, right? And these firms are natural candidates for acquisition by other firms with better management. Right? So in some cases, better management may simply mean that the determination of forced painful cuts or realign a company's operation. Right? And here, acquisition is simply the mechanism to replace the management team. Right? For example, Marty McConnell find that the chief executive or CEO is 4 times more likely to be replaced in a year after takeover than during early years. Right? So this is the target company is not doing well, right? It's not managing the company well. That's what acquire and outsider might come in and say, we want to acquire the companies. And by our new managers, they can better manage the company, right? So that's kind of my idea. And also industry consolidation, right? For example, industries with too many firms or too much capacity can trigger a wave of merger acquisition, right? One example is the banking mergers following deregulation of interstate banking. Right? So interstate banking, I mean, the deregulation of interstate banking means that in 1980s or early 1990s, right, there's a wave of deregulation efforts that try to allow banks to enter into other states, right? So then this creates a large merger wave because, I mean, one quick way to enter into another state is basically acquire another bank in other states, right? So that's why a lot of bank mergers at that time. So we have talked about the fundamental economic reasons for why we want to do a merger, right? But there are also kind of incentives that are not very fundamental, not very kind of related to economic benefits, right? For example, diversification. I mean, sometimes firms do not know why they want to diversify, right? There's no clear reason why they want to diversify. There's no clear net benefits from diversification. Second, increasing earnings per share, right? That's like the bootstrap game. The idea is that acquire generates earnings growth not from capital investment or improved profitability, but from purchase of slowly growing firms with lower price earnings ratio. Right? And because they acquire this slowly growing firms with low price earnings ratio, right, they can justify the merger by having a higher earnings growth rate after the merger. I mean, even if we don't know, I mean, whether they are really kind of synergy or net benefits from the merger. Finally, there's also another dubious motive, which is the merger can lower the financing cost. I mean, sometimes it's just a belief of the manager. So the belief is that a merged firm is able to borrow more cheaply than its separate units could. So diversification is easier and cheaper for the shareholder than for the company, right? So corporate diversification does not increase value in private markets, right? As long as investors' diversification opportunities are unrestricted. So, I mean, this is similar to actually one of the arguments we have in the Miller-Morgellini theorems, right? In the Miller-Morgellini theorems, one of the arguments is that investors, they can do the diversification themselves, right? They can replicate the capital structure of the firm, right? So here, I mean, not only can investors replicate the capital structure of the firm, they can also, for example, replicate the diversification, right, of the firm. For example, if the firm wants to or is planning to enter into another industry, the investor can do this diversification by buying stocks in the industry that the company is thinking about entering. Right? And so this is diversification. Second, let's look at this example, right? Increasing earnings per share. Right? So here we have two companies, right? World Enterprises and Merck & Slurry. Right? So World Enterprises, they're trying to acquire this company called Merck & Slurry. And we have shown the earnings per share world prices before the merger and the world prices after the merger, right? Because after the merger, this Merck & Slurry does not exist, right? Became part of the World Enterprises, right? Now you can see previously the EPS of the two companies, they are the same, right? But after the merger, the World Enterprises EPS is going up, has gone up, right? And the price per share is the same, right, for the World Enterprises. That's our assumption. The price earnings ratio is 20 before and 15 after. We have also shown here the number of shares, total earnings, total market value. Right? Now, the current earnings per dollar invested in the stock could be calculated as using the earnings per share divided by price per share. Right? So this is all the information. So basically here, what enterprises they can acquire the 100,000 Marcus Lorry shares for 50,000 of its own shares, right? And the total earnings double as a result of merger, right? It's just what we see here. But the number of shares increased by only 50%, right? So here the earnings per share rise from 2 to 2.667, right? You can calculate this number by using the total earnings divided by the number of shares, right? You can just get a number. So the conclusion is that there's no increase in the firm's combined value. So, and since the stock price is unchanged, the price earnings ratio falls. So this is what we have observed. So the graph will be like this, right? This is the what enterprises before the merger, what enterprises after the merger, and this is Marcus Lorry. So the idea is that the Marcus Lorry shareholders, they get lower immediate earnings, right, but faster growth. So that's why neither side gains or losses, because I mean it's kind of even. But just you can see here, right? This is Marcus Lorry. After the merger, this is the combined company, right? The earnings growth become faster, right? But of course, the cost is the earnings growth of this whatever enterprises goes down. Right? So this is the earnings gain, right? But now you can see, I mean, it's not just that there's net benefit. There are no net benefits, right? They're just planning this EPS gain, right? To kind of convince the target shareholder, yes, the merger can increase the growth of the earnings per share, right? Which is not necessarily related to net benefits. Right? So the third one is called lower financing costs, right? This is some managers they believe that when the two firms merge, the combined company can borrow at a lower interest rate. Right? The idea is that because you have two companies, right, there could be mutual guarantees, which make the debt less risky. And in our case, lenders will demand a lower interest rate. So lower interest rates comes at the expense of having to guarantee more debt, right? So you can see that's not a straightforward argument, right? So I mean, it could be that with mutual guarantees, right, the cost of debt goes down, right? For example, the large company acquires small company, right? Small company initially, the cost of debt is high, but if they are bought by a large company, the cost that will be lower, right? I mean, that's a positive argument. But on the other hand, if you have two large companies merged together, right, their debt level, they're both high. The level of the debt is both high. So in our case, the cost is that, I mean, they both have to guarantee more debt. Now let's do a basic estimation of the merger gains and costs, right? So there's an economic gain only if the two firms, they're worth more than the part, right? That is, for example, the gain is the present value of the combined company, right, minus the sum of the value of the two separate companies, right? And the net benefit is the gain. And the cost is, what is the merger cost? What is the acquisition cost? It will be equal to the cash paid minus the present value of the company B. Right? So that will be the cost. Because you pay maybe 1 million for this, 10 million for this company, right? And this PVB, it's like the intrinsic value of this company, right? And the NPV here of the deal will be the gain minus the cost, right? Will be this one to be the synergy minus the cost, right? So that will be the net present value of acquiring this company. So the general rule is that you want to go ahead with the merger if NPV greater than 0, right? The benefit is that the benefit depends on whether there are any gains to be made from the merger, right? The cost is the division of these gains between the two companies. So now let's look at one example. So in this example, the present value of company A, the value of the A is 200, right? The value of B is 50. The gain here is the change in this one here, right? So that will be the synergy, right? The synergy here will be 25, right? Or the gain. And the value of the combined company is 275, right? So now suppose company B is bought for cash for 65 million. So in that case, cost will be equal to cash paid minus the value of B, which equals 15 million, right? Now in that case, the NPV of doing this acquisition will be the wells with merger minus the wells without merger, right? Which will be, so this is wells with merger, right? This is synergy minus the cost, right? The cost is how much you paid, right? And then minus this PVA. PVA is the wells without merger from the acquired perspective. So then the NPV will be 10. Right? So the announcement, because the NPV is 10, right? So that's what the announcement will cause the value of B stock to rise from 50 million to 65 million, right? So now if investors share management's assessment of the merger gains, the market value of A stock will increase by 10 million. Okay? So this is a simple calculation. So there could be right or wrong ways to estimate the benefits of merger, right? So for example, what is the estimated net gain, right? The estimated net gain is the DCF valuation of targets, right? Including merger benefits minus the cash required for acquisition. And when analysts make this prediction, they can make errors in valuing a business, right? So basically, one should start with the target standalone value and concentrate on the changes in the cash flow that will result from the merger. Right? You need to focus on incremental changes. Right? So you add a value, or the merger creates value only if you can generate additional economic rents, right? The net benefits apart. So next, the question is, what if the target stock price anticipates the merger? Right? For example, the target price increases, let's say, 2 months before the merger announcement. Right? Now, in that case, it's not just the price that the kind of acquired paid, right? So it's when they negotiate for this particular price, right? When they negotiate for this transaction value, they have to take into account what kind of price they're looking at, right? Are they looking at the current market price? Maybe, I mean, if they negotiate, I mean, the 2 months before the merger, then this price might well already incorporate the merger news, right? Which will be higher, right? So the cost of the merger is essentially the premium that the buyer pays over the seller's standalone value. Right? So that's why here there's a distinction between the market value and intrinsic value. Right? I mean, for example, for example, the company is the intrinsic value is 1 million, for example, right? Now, the market overvalued this company, right? The market overvalues the company, then the company is actually worth 1.5 million, right? Now, when the acquirer approaches the target, right? There's no way that acquire, let's say they pay 1.2 million, right? They have to pay above the market value, right? That's like the negotiation. I mean, that's like the negotiation rule, right? I mean, if you negotiate with the target, right, the target will always want a premium over the market value, right? Not the intrinsic value, because there are always, I mean, controversies, or there are always divergence in opinion in terms of the intrinsic value, right? So that's why they will focus on the market value. So that's why we focus on the premium, right, relative to the market value, not the intrinsic value. Right? From the investor perspective, if there's no merger, that will be the value of company B, right? If the merger occurs, then the value will be the value of the B plus and part of the benefits of the merger. Right? So this is what the acquirer will pay. Right? So if the second outcome is possible, the market value overstates the value. All right, so this is kind of an idea, because if the merger occurs, it will be equal to, let's say, the value, I mean how much acquired pay, or the premium will be equal to like value of the B plus some part of the benefits of the merger, right? So in that case, if this is the market value we're talking about, then the market value overstates the value of B. So let's look at this example. Now let's look at one example here. We have two firms. Firm A, the market price per share is $200. For company B, the price per share is 100, right? So the number of shares for A is 1 million, right? For firm B, it's 500,000, right? So then the market value of firm is calculated as the price per share times the number of shares, right? Now in this case, firm A intends to pay 65 million cash for B, and if B's market price reflects only its value as a separate entity, in our case, the cost will be equal to cash paid minus the value of B, right? So in our case, it's 65 minus 50, right? So 50 is the value of B, right? So then the cost will be 15 million. Now suppose there are merger rumors, the news about a merger before the public announcement that increases the cost of acquisition. So suppose B's share has risen by $12 because of merger rumors. Now in that case, the intrinsic value will be overstated. All right, it will be overstated by 12 times the number of shares, right? 12 times the number of shares, then that will be equal to 6 million, right? So that means the intrinsic value will be overvalued by 6 million. And if the true value is 44 million, then in that case, the cost will be 65 minus 44, right? Which will be equal to 21. Right? So this is the adjusted cost when you have a merger news. Now in that case, you can see B's shareholders now are capturing the lion's share of the gain, right? Because the idea is that B's price increases before the merger, right? So that creates higher cost for A, right? But this is good news for B, right? Because any payment that company A overpays goes to B's shareholders' pockets. Right? That's why shareholders of B are capturing the lion's share of the gain. Right? Now, next we're gonna look at how do we estimate a cost when a merger is financed by stock. So when a merger is financed by stock, the cost depends on the value of the shares in the new company received by the shareholders of the selling company. So basically, in a stock transaction, the acquirers use their stocks to exchange for stocks in the target company. Right? So if the target receives n shares, each worth, this is the value of a combined company, then the cost is n times PAB minus the value of company B. And this PAB is the post-merger price. Now suppose company A offers 325,000 shares instead of 65 million in cash. Right? And A share price before the deal is announced is $200, right? So we saw in the earlier table. And suppose B is worth 50 million standalone, right? Then the apparent cost here is 0.325 times 200. This is the number of shares of B, right? Times the price of A, right? So minus the value of B, right? So just using the formula here, or value of B, which will give you 15 million, right? Now in that case, the new firm will have 1.325 million shares outstanding, right? And it will be worth 275 million, right? Now the new share price is this new value of the company divided by 1.325, right, which gives the new share price. And then the true cost is 0.325. This is the number of shares they offer, right, times the new share price, right, minus the value of B, right? This is the true cost. So this is how we calculate the cost of buying a company when a merger is financed by stock. Now, if it's a cash offer, then the final value of the firm is 275 minus 65, which is 210. Right? So in that case, the share price will be 210. The cash deal actually is better for the acquired shareholder. So in general, if B shareholder are given a fraction X of the combined firm, right, then the cost will be, this is the fraction X of the combined company times the value of the combined company minus the value of B, right? So if cash is offered, the cost of the merger is unaffected by the merger gains. Right? Now, if the stock is offered, the cost depends on the gains because the gains show up in the post-merger share price. Right? So that's why this is the major difference between a stock offer and a cash offer, right? Because when a cash is offered, the cost of the merger is unaffected by the merger gains. So because, you just pay how much you have negotiated with the target. But when a stock is offered, the cost depends on the gains because the gains show up in the post-merger share price. Right? Your share price is related to your cost. Here. Now, in general, stock financing also mitigates the effect of overvaluation or undervaluation of either firm. Right? Suppose A overestimates B's value as a separate entity because it has overlooked some hidden liability. So, other things being equal, company A shareholders are better off if it is a stock offer rather than a cash offer. Right? Because if you have a stock offer, right, and then you are not really sure about B's value, then if there's a bad news about B, then this inevitable bad news about B will fall partly on the shoulders of B shareholders, right? So that's the idea. Ace manager. So this also relates to the asymmetric information here, right? So, okay, now let's do some recap of the previous calculation. So here we say that if there's a merger rumor, right, so that increases the cost of buying the firm. Here, the intrinsic value is overstated by this 12, right? This 12 is because of the merger rumors. Therefore, the intrinsic value is overstated by 6 million. And the true value is 44 million, right? Exactly because the value of the firm is 50, right? But because this 50 includes the stock run-up, includes the overstatement that is coming from the merger rumor. Therefore, we subtract 6 from 50, we get 44, right? So this is the true value. That's why the cost is 21. Right, so then B shareholder are not capturing the lion's shares of the gain because because A have to pay higher, right, to buy B. This is simply the idea. Now let's go to this example. This example is a stock merger, right? So suppose A offers 0.325 million shares instead of 65 million in cash, right? Now in that case, the parent cost is very simple to calculate, right? It will be just how many shares you kind of use, and this is A's price, and then minus the value of B, the standalone value of B, and what you get is 15. Now this is the parent cost, but there's also a true cost here. The true cost is considering the stock price increase after the merger. Right? Now the new firm will have 1.325 million shares because first of all, A has 1 million shares outstanding in the beginning, right? Now A also offers or issues 3 to 5,000 shares, right? That's why in total it will be 1.325 million shares, right, outstanding. And what is the new firm's value? The new firm's value will be it will be 200, right? 200, the market value of A, plus market value of B, and then plus the synergy that we have talked about. Let me check. So here we're gonna assume, so I didn't write on the slides, but we assume that the kind of synergy here is 25. The synergy here is 25, so that's why we get 275. So you can look at a book and try to see where this 275 come from. Basically, it is the value of the combined firm, right, which was 200 plus 50 plus the synergy, the net benefits of the merger. And that's why the new share price will be 275 divided by 1.325, and then you get 207.55. And then you can calculate the true cost, right? Remember the true cost, the difference between true cost and the parent cost is the true cost, taking into account the fact that there is a net benefits of the merger, therefore the stock price after the merger reflects that kind of benefits. And if it's a cash offer, then I mean it's just simply the value of the firm will be simply this is the value of the combined firm minus 65, right? This is how much you pay, which will be equal to 210, right? Now in that case, the share price will be 210, right? And then obviously you can see the cash deal is better for A shareholder, right? Because the new share price for A, if you use the stock offer, it will be 207, right? But it is lower than 210, which is the price of company A, right, after the merger if they use a cash consideration. Now, in general, we can express the cost. The cost will be the fraction of the combined firm, right? X times the value of the combined company minus PVB, right? This is the value of B. If cash is offered, the cost of merger unaffected. Like I said, if stock, I mean, you can see here, right? If cash is offered, the cost of merger is unaffected by the merger gains, right? It's just, this is the value of the combined company and has nothing to do with the gain. But if the stock is offered, the cost depends on the gains because the gains show up in the post-merger share price, right? That's kind of idea. And here, the stock financing also mitigates the effect of overvaluation and undervaluation of either firm, right? Like I said, if there is any undervaluation, overvaluation of B, right, then the inevitable bad news about B's value will fall partly on the shoulders of B shareholder, right? A and B share the cost of information, so share the cost of, let's say, uncertainty, the valuation of B, right? That's why this is a potential advantage of using the stock offer. And suppose we had asymmetric information, right? Suppose A's manager, they are more optimistic than outside investor, right? So they know that the A shares will really worth 215 after the merger, right? That is 7.45 higher than 207.55. Right? Then the true cost of the stock finance merger with B is, this is the true price, right? The real price after the merger times the number of shares, right? Minus 50, right? So it will be 18.588, right? So now in this case, you can see the target shareholder will get a free gift of 7.45, right? Which is the difference between a cost where you have no information symmetry versus the cost where you have information symmetry, right? So then target shareholder will get a free gift of 7.45 for every A share they receive, right? That will be extra gain of 0.42, right? That's why financing with stock will be favored by pessimistic manager who think that company shares are overvalued, right? You use overvalued to buy another company, or in order to, I mean, because it's a good deal for you, right? Simply because you know that, I mean, it's simply because you have like 100 shares, right? You know the intrinsic value is 1 million, but actually the value of the shares now on the market is 2 million, right? Now you just have one extra million to spend, right? Why don't you use this overvalued shares to buy another company, right? This paper by Andre, Michaud, and Strafford, they find that the average market-adjusted reaction to the announcement of stock finance merger, it's about negative 1.5%. So indicating that market knows that when you use a stock offer to buy another company, your company's stock is overvalued. The next part of the merger is that the antitrust law also plays an important part in approving the merger. So if you have a horizontal merger, usually that might create antitrust concerns, right? Then FTC and the Department of Justice will try to evaluate the effect of the horizontal merger on the market to make sure that this merger does not hurt consumer welfare, right? That's why there is a set of federal antitrust laws. So basically the Clayton amount of, we have the classic Clayton Act of 1914, right? This forbids an acquisition whenever in any line of commerce or in any section of the country, the effect may be substantially to decrease competition. So many horizontal mergers, they actually have to go through the scrutiny of the Department of Justice and FTC, right? And in 2015, the 70 billion takeover of Time Warner by Comcast was abandoned because of antitrust concerns. And GE's 46 million takeover bid for Honeywell was also rejected because of antitrust concerns. One of the potential remedy when you have cases like this is that the kind of the authority will ask you to do some remedy, right? To do some remedy to reduce to kind of increase the competition in the industry. Right? So for example, when American Airlines and US Airways announced to merge, the Justice Department required the company to sell landing slots, gates, and grounding facility to low-cost airlines, right? This is a way to increase competition, right? So that's why only when the merger partners or these two companies agree to do those remedies, then the authority, the Justice Department and SEC will approve the merger. So usually when when FTC and the Justice Department try to evaluate the merger, try to see whether the merger acquisition creates an antitrust concern, they will use or calculate this Herfindahl-Hirschleifer index of market concentration to kind of make sure that this merger does not create any antitrust concern. And this index is calculated by summing the squares of the individual firms' market shares. In general, when the HHI is below 1,500, then it's an unconcentrated market. So this merger will not create any antitrust concern. When HHI is between 1,500 and 2,500, it will be considered as a moderately concentrated market, right? And if this HHI is above 2,500, it will be considered as highly concentrated market. So therefore, in that case, it will be considered raising the antitrust concern. Now, if the merger creates very small changes in the concentration, so let's say 100 points, then there's no problem with it. If the merger results in unconcentrated market, meaning that there's little change or there's actually even decrease in the market concentration, then there's no concern, right? So both cases are unlikely to raise any antitrust concern. But if you have a merger that have outcome that results in moderate concentrated markets, right? For example, increases of HHI of more than 100 points. Or if the merger has resulted in highly concentrated markets, for example, the increase of the HHI is between 100 to 200 points. In that case, or if the merger results in an increase in the HHI in more than 200 points, then it will consider to enhance market power. Then this will raise competitive concerns. In other words, the merger will create anti-competitive effects, right? And then the merger transaction will warrant scrutiny, right? But this is the regulation part. But recently, I mean, in recent years, we also have seen the increasing kind of tension between China and the US, right? So that's why economic nationalism also will put pressure on mergers, right? So that's why, I mean, in recent years, US has increasingly banned the Chinese firm to acquire US firms. So in 2006, US Congress voiced its opposition to the takeover of Britain's PO by the Dubai company DP World, right? The acquisition went ahead only after PO's ports in the United States were excluded from the deal. Right? And also in 2012, right, the US House of Representatives recommended that the federal government should block mergers of US firms with Chinese telecommunications company, right? To kind of mitigate those national security concerns, right? That's the idea. And in general, the form of the acquisition, in most cases, there will be a complete merger, meaning that one company automatically assumes all the assets and all the liabilities of the other company. And such a merger must have the approval of at least 50% of the shareholders of each firm. Right? And a buyer can deal individually with the shareholders of a selling company. Right? So for example, it's like a tender offer. So if it's successful, the buyer has control and can complete the merger and toss out the incumbent manager. Right? And another type of merger that is less popular is merger of assets, right? You don't get, you don't acquire the entire control of the target company, but rather than that, you buy the assets of the target company, right? So in that case, the ownership of the assets need to be transferred, right? Not the ownership of the company, and the payment is made to the target firm. And finally, there are some tax consideration regarding in the merger acquisition transaction. If you do a cash transaction, you have to pay tax on the capital gains, right? And if you do stock acquisition, the acquisition is tax-free, and the shareholders are viewed as exchanging their old shares for similar new ones, right? So therefore, in that case, there's no capital gains. Yeah? So you can see stock transaction obviously has this tax consideration or tax-free advantage over cash acquisition. So after the tax-free acquisition, the merged firm is taxed as if the two firms had always been together, right? In a taxable acquisition, however, the assets of the selling firm are revalued. The resulting write-up or write-down, meaning that the value increase or value decrease, is treated as the taxable gain or losses, right? And then the tax depreciation is recalculated on the basis of the restated asset value. So this is another disadvantage of the taxable acquisition, typically cash transaction. Well, let's continue to talk about corporate governance. So basically, merger acquisition, basically it's a corporate governance mechanism because it's almost like it's a market for corporate control, right? So if the managers of the target firm are not suitable for the firm or they cannot manage the target firm well, then there will be external acquired. There will be external pressure to replace the current management. So that's why it's a market for corporate control. Whoever can manage the company the best will get to manage the firm, right? Either by acquiring the firm or by launching a proxy fight, which we're not talking about now. So the ownership or management of large company, they are separated because I mean, we guys, I mean, we are the investors or shareholders or retail shareholders of the company. But normally a public company has thousands or even millions of shareholders, right? So it's impossible for all of them to manage the company, right? So you got to have you got to delegate it. I mean, shareholders got to delegate their rights, right, to the manager. So the manager operate the firm on behalf of the shareholder. Right? So that's why the ownership and management of large company, they are separated. So the company is owned by shareholder, but managers, which sometimes different from the shareholder. They got to manage the firm. Then, but in this process, shareholders want to make sure that the managers goal is to maximize the shareholder value, right? They need to make sure that managers keep on doing that, right? So then one way they can do is that shareholders, they can elect a board of directors, right? And the board of directors is responsible for overseeing the managers, right? So make sure that the managers do not take action that are value decreasing for the shareholder. But even if shareholders elect board of directors, they have little say in the most management decision, right? They can submit shareholder proposals in order to change something on annual meeting, but usually that kind of mechanism is also not very powerful because the proposals are non-binding. Right? So even if they submit it, and they vote on it and the proposal gets passed, but managers still have the ultimate discretion where they can choose to not implement it, right? So that's why there could be agency costs arising when managers and directors are tempted to make decisions that are not in the shareholders' best interest, which occurs in many cases. So if it's possible for the value of the firm to be enhanced by changing the management or by reorganizing under new owners, then there will be incentives for someone to make the change. So there's three particular ways to change the firm management. First is you can launch a successful proxy contest. So in the proxy contest, there will be shareholders, a group of shareholders, right? Not every one of the shareholders. They will vote in a new board of directors who then pick the new management team, right? So the first thing they're gonna do in the proxy fight is that they're gonna try to replace the current board. And for example, hedge fund activists, right? Hedge fund shareholders, they hold part of the firm, right? They can use their voting rights to launch a proxy fight and then to replace their directors, right? Their favorable directors, right? And then their elected directors can pick the management that they prefer, right? Instead of the current ones. The second way to change the firm management is a takeover, right? So I mean, another firm came in and say, the company is not doing well, right? So it's because the current manager are not doing a good job, right? So in our case, the acquirer can replace the target manager, right? Third way, you can do a leverage buyout of the firm by a private group of investors. So it could be that this leverage buyout, it could be done by a private equity, right? So private equity can do a leverage buyout. So in a leverage buyout, usually the transaction is funded or is financed by debt, right? So that's why it's called leverage buyout. So suddenly the leverage of the firm could be increased. So first of all, in the proxy contest, that's usually happen when a group of investors believe that the board and its management should be replaced. Right? So they can launch a proxy contest at the next annual meeting. So in this particular proxy contest, the dissident shareholder who disagree with the manager, right? So they attempt to obtain enough proxies to elect their own slate to the board of directors, right? And once the new board is in control, management can be replaced and the company policy could be changed, right? So that's why a proxy fight is very aggressive tactic used by shareholders to voice their concern. It is a direct contest for control of the corporation. Right? And many proxy fights are initiated by major shareholders who consider the firm poorly managed. Right? And proxy contests, they are expensive and difficult to win. So in the meantime, shareholders have found that a policy of just say no to the re-election of existing directors can send a powerful signal. Right? For example, if there's a director re-election, shareholders can vote against the director, right? So that can still, I mean, even if in many cases that's futile, right? So I mean, the director shareholders do not like can still get you re-elected, right? But that sends a strong signal to the directors, right? Meaning that the shareholders are not satisfied with their performance. So for example, when Disney shareholders voted 43% of the shares against the re-election of CEO, and the CEO resigned the next day. Right? So the second mechanism is takeover, right? The takeover, that would be acquired, they will make a tender offer directly to the shareholder. Right? Because, I mean, why do they make a tender offer? Because they know that when they make an offer, managers will oppose to the offer, right? So that's why they will directly go to the shareholder and make a tender offer. The tender offer is just like it's an offer to buy shares directly from shareholder. Right? So if the offer is successful, the new owner is free to make any management changes. And the management of the target firm might advise the shareholders to accept the offer, right? Or they might fight a bit. Right? So let's look at one example where the managers fight fiercely when they have this offer coming. So in June 23, right, Oracle announced the 5.1 billion cash tender offer for its rival PeopleSoft. Right? And the offer price of $16 a share was only a modest 6% above the recent price of PeopleSoft as well. Right? So in our case, the PeopleSoft CEO angrily rejected the offer, stating that the offer is too low. Right? And he also accused Oracle of trying to disrupt PeopleSoft's business, right? He also accused this company to thwart its recently announced plan to merge with smaller rival JD Edwards. Right? So I mean, they also went for the kind of more aggressive way. PeopleSoft immediately filed a suit claiming that Oracle's management had engaged in acts of unfair trade practices and had disrupted PeopleSoft's customer relationships. Right? In another suit, JD Edwards claimed that Oracle had wrongly interfered with its proposed merger with PeopleSoft and demanded 1.7 billion in compensatory damages. Right? So this was very aggressive, right, to prevent Oracle going forward. So they also use a poison pill, which is a very common anti-takeover defense tactic. So they install a poison pill. This poison pill allowed the firm to flood the market with additional shares if the predator acquired 20% of the stock. Right? And the company also instituted a customer assurance program. So in this customer assurance program, it offers customers money-back guarantees, right, if an acquirer were to reduce customer support. Right? So at one point in the takeover battle, the potential liability reached nearly 1.6 billion, right? Which means if Oracle were to take over the PeopleSoft, it will take over a very high liability, right? Which can reach 1.6 billion, right? So that can also make the acquisition attempt of Oracle very costly. And the elections to the PeopleSoft board were also staggered, right? So in United States, there are two kinds of board. The first kind of board is staggered board, right? And another type of board is unitary board. In a unitary board, each director of a public company gets elected they need to be elected every year, right? But in the staggered board, each director only gets to be elected every 3 years, right? So that's why in order for the Oracle to replace the board of directors, right? Because the directors of the PeopleSoft, they hated Oracle so much, right? They don't want to accept any offer. So in order to replace the board of directors, right, that will take much more time. It takes 2 annual meetings to replace the majority of PeopleSoft, which is very costly for Oracle. Right? So, and also, U.S. Department of Justice also ruled that the deal was anti-competitive, but Oracle appealed the ruling, right? So you can see there were many obstacles to the acquisition of Time Oracle, but Oracle tried very hard to swap these kind of to reduce those kind of costs, right? They appealed to the Department of Justice ruling, right? Finally, it won, right? Also, Oracle revised the offer 4 times, right? It increased the offer first to 19.5 and then to 26, right? And then Oracle reduced the offer to 21, right? Starting a drop in the price. 6 months later, it raised the offer again to 24. Right? And also, it warned investors that it will walk away if the offer was not accepted by the board or majority of the shareholders. Right? So that created pressure for PeopleSoft shareholders. Right? So finally, 60% of PeopleSoft shareholders indicated that they wish to accept this last offer, right? But before Oracle could gain control of the PeopleSoft, they still need a company to get rid of the poison pill, right? Which was set up by the board of directors, right? And also the customer assurance mechanism. So in that case, Oracle tried 2 tactics, right? First of all, it initiated a proxy fight to change the composition of PeopleSoft's board, right? It also filed a lawsuit in a Delaware court alleging that PeopleSoft's management breached its fiduciary duty, right? By trying to thwart Oracle's offer and not giving the due consideration. So Oracle's battle proved to be successful finally, right? So with 60% of PeopleSoft shareholders in favor of taking the offer, then PeopleSoft's managers find themselves in a very difficult situation to further reject the offer, right? Because most of the shareholders, they already are happy with the offer, right? So finally, Oracle increased the offer to 26.5, right? So then PeopleSoft management lifted the defenses, and then within a month, 97 of PeopleSoft's shareholders had agreed to the bids, right? So in this example, we already saw this very popular takeover tactic, right, which is poison pill. And there are also other tactics, right? For example, there could be shock repellent changes to the corporate charter, right? For example, the charter might be amended to require that any merger must be approved by a supermajority of 80% of the shares rather than a normal 60, right? So this makes the approval of the merger quite more difficult, right? Because it has a higher threshold. Also, the poison pill tactic, right? So other defense tactics are used to defeat the bid and protect managers' positions with the firm. And another way in face of these tactics, right? Acquire also use their tactics to make the merger more smoothly, right? They don't want the target management to fight against it fiercely, right? So that's also because it will be very costly for the acquire as well, right? So they can do so by offering the target managers golden parachutes, right? For example, it's a lump sum payment, a lump sum compensation for the target manager, right? So that target managers are happy with the offer and accept the offer. Right? So this poison pill was invented by MA lawyer Martin Lipton, right? Initially, it was initially as a response to tender-based hostile takeover, right? Tender offer, which directly goes to shareholder, right? And poison pill became popular during the early 1980s in response to the wave of takeovers by corporate raiders such as Carl Icahn, right? And what is a poison pill, right? It's basically a shareholder rights plan. And this particular plan gives shareholder the right to buy more shares at a discount if one shareholder buys a certain percentage or more of a company shares, right? For example, if this potential bidder or a hostile bidder came to the target management and they buy, let's say, a certain percentage of target shares, so like this 5%, then target target manager, they can activate this poison pill, right? So then they can offer a discount, offer this plan to their existing shareholder, right? So the existing shareholder, they can buy the shares at a discount, right? Maybe 50%, right? Now, in that case, the potential bidder, they cannot buy it at a discount, right? So that you can see this way, it diluted this potential bidder's ownership, which makes the accumulation of the further stakes in the company more difficult, right? It will be more costly for the potential bidder to further accumulate any stakes or to kind of further buy the merger. So this table summarizes other tactic, right? For example, staggered bar, which we talk about, supermajority, or supermajority. I also mentioned this, right? So if in the majority voting for MA, the the passing threshold is 50%. In a supermajority, it's 80%, right? Also, like fair price, right? The fair price defense means that mergers are restricted unless the fair price is paid, right? Also, restricted voting rights, right? So, for example, shareholders who acquire more than a specific proportion of the target have no voting rights, right? This is also targeted at those potential bidders. And also waiting period, poison pill, poison puts, and also there are post-offer defenses. For example, litigation, asset restructuring, liability restructuring, right? In particular, liability restructuring means that the target issues shares to a friendly third party, right? Then it will increase the number of shareholders or repurchase shares from existing shareholders at a premium, right? Again, this was designed to make sure that the cost of buying more stakes of the target company very costly, right? Now so now we go to the question, right? Who gains most in the mergers? In general, researchers, they find that targets or sellers generally do better than buyers, right? This paper find that following the announcement of the bid, selling shareholders receive a gain averaging 16%. And the overall value of the merging firm, buyer and the seller combined, increases by about 2% on average, right? The stock price of the acquiring firm decline on average, right? So that seems to suggest that target shareholders on average, they actually gain from the merger, right? For example, when Bristol Myers Squibb acquired biotech company Inhibitex in 2014, right? This company paid a 163% premium for Inhibitex stock, right? So then, given that the market reaction to the acquired offer on average not very favorable, right? The question is, why do firms still acquire? Okay? So one explanation is that this is due to hubris or overconfidence, right? So it's because CEO is overconfident. CEO is too confident of their ability of estimating the right price for the target, the ability to picking the good target. Right? So this paper finds that firms can enter a market either by building a new plant or by buying existing businesses, right? Which points to another kind of reason for why firms are still doing kind of merger, right? One of the reasons is that they're trying to enter into this market, right? So then, if the market is shrinking, the company it will make more sense for the firm to expand it by acquisition. So that's why when the acquirer announces the acquisition, firm value might drop simply because the investors conclude that the market is no longer growing. Right? So the acquisition in this case does not destroy value, right? It just signals that the market is stagnant, right? The market doesn't grow. And because earlier we said that targets or sellers, they usually earn high returns, right? Then there are some kind of reason for it, right? One reason is that buying firms are typically larger than selling firms, right? They're willing to pay more, they're capable of paying more. Second is that because usually for smaller targets, for sellers, they're usually sold through auction, right? Where there are multiple bidders participating in this process, right? So in that case, there will be competition among potential bidders, right? And the competition drives the price up. And there's also method of transaction in a merger acquisition, right? Usually about 50 to 60% of the firms that are sold through auction where multiple bidders participate. And they are used, this auction method where multiple bidders participate, are used more often in small firms and in firms that sell for financial value. Right? So why it's for financial value? It's because usually firms that have common valuation of the firm, so let me put it this way, right? So if you want to find a set of firms whose valuation of the firm is more common, then it got to be the financial value, right? Because there's no strategic, so the strategic fit of the target and acquire, this is very special. This is very unique there may be one or two, there might be only one or two companies that might have the very special, good strategic fit with the target company, right? But if it's the financial value of the target, then many bidders can kind of be in that role, right? And negotiation, usually it's one-to-one negotiation, right? So that's why it's usually for strategic value. On average, there are some studies who find there's no wealth effect of these two methods, right? And in general, when we think of merger activity, it's a very important aspect of the macroeconomy, right? There was an upsurge in the M&A activity from 1967 to 1969, and again in the late 1980s and 1990s, right? And there's also another merger boom got underway in 2003, right? Only to peter out with the onset of credit crisis, right? However, 2005 find that merger waves are mainly driven by industry shock. For example, there's a new technology being developed. There's a new machinery, that a new type of production method that was introduced into the industry. And do mergers get general net benefits? Right? For example, I mean, this question is simply, do mergers have synergy? So one difficulty of answering this question is that it will be, in general, difficulty estimate post-merger benefits, right? Because, there are studies who find that productivity increases following the merger. Right? For example, this paper by Xiaoyang find that acquires increased targets productivity through more efficient use of capital and labor. Right? For example, by reducing the capital expenditure, wages, and employment, and by improving the target's investment efficiency, right, through reallocating capital. Now we're going to talk about corporate restructuring. All right? One of the corporate restructuring is one type of corporate restructuring is called leverage buyout. Yeah? The leverage buyout is a very special type of M&A actually, right? And they differ from ordinary acquisition in two immediately obvious ways, right? First of all, in MBO, there's a large fraction of the purchase price is financed by debt. And some of the debt is junk below investment grade, junk bond below investment grade, right? The company goes private and its shares no longer trade on the open market. And there's also equity financing here. So LBO, there's also some investors who provide equity financing in LBO. This equity financing usually comes from private equity investment partnerships. And in a special case, we also have the management buyout. Right? Management buyout is a buyout where the buyout is led by existing management. All right, so the existing manager, they can cooperate with private equity or private investors, and then make an offer to the public company and take it private. Right? So this is kind of the idea. So now let's move on. Let's see some example of the LBO, right? So for example, in the utility industry, there's a very big LBO by TPG, KKR, and the target is TXU, right? So you can have a look. And this LBO wave, they occurred shortly before the financial crisis struck in 2007, right? And there are lots of huge transactions were completed before that. So it's because in the periods before the financial crisis, the access to credit is relatively very easy, right? So that's why it was very easy to borrow money. That's why and the volume of the LBO, right, which highly depends on the debt you borrow, goes up or went up, right? But by 2009, right, because of the financial crisis, the number of deals was down nearly 90%. So here, this describes a famous LBO deal, right? The RJR Nabesco LBO, right? We can take a look of the detail of the process. I'm gonna skip this. So let's go. So now The question is, does LBO create value, right? Compared to normal acquisition, do LBOs create value? So from the example we just saw, right, the most important source of added value came from making RJ and Nabesco more efficient, actually, right? The company's new management was forced to pay out massive amounts of cash to service the LBO debt. Right? It also had equity stake in the business, therefore, the managers have strong incentive to sell the non-essential assets, right? To cut the cost and to improve operating benefits. Right? There are also motives for the LBO efficiency, right? For example, cheap funding from the junk bonds. And there's also value of the interest tax shields, right? Which we mentioned earlier when we talk about financing. And the bondholders' losses were also high, right? So they're far less than the shareholders' gains, right? I mean, another way to put it is that you see lots of value created in the LBO, but essentially, this is the transfer of value from the bondholder to shareholder. Because I mean, in the LBO, the company has undertaken lots of debt, right, which increased the default probability, right, making the life of the bondholders more difficult, right? And finally, leverage and incentive, right? So let's talk about this in detail. During the 1980s, the average increase in operating performance, right, operating income of 24%, 3 years after the buyouts, right? In particular, the ratios of the operating income and net cash flow to assets and sales increased dramatically, right? We also see cutbacks in the capital expenditure, but not in the employment, right? So one way to see it is that we see operating changes that are due to improved incentives rather than layoffs. So why is this the case? It's because many of the companies that are engaged in a LBO, leverage buyout, they have done this leverage restructuring, right? This leverage restructuring, they are designed to force mature, successful, but overweight company to disgorge cash, reduce operating costs, and to use assets more efficiently, right? In 1989, Sealed Air was a very profitable company, right? In that time, the company relied on patents and were not ready for competition when patents expired. The solution to kind of improve the firm at that time was to borrow the money to pay a 328 million special cash dividend, right? So then this suddenly increased the leverage of the firm. Right? The requirement to generate cash for that service is intended to foster improvements to operating efficiency, right? And because so there is a classic agency problem, which is called free cash flow problem, right? If there's a lot of free cash flow in the firm's balance sheet, managers will tend to use that free cash flow to maximize their own benefits, or to even waste those cash flow in unnecessary investments, right? In kind of wasteful investments. So in that case, if you do this leverage restructuring, right, essentially you borrow lots of money from the bank and to kind of force the firm to increase the leverage. In that case, you raise the debt level, right? So then it doesn't eliminate this free cash flow problem, right? Second, managers are given greater stake in the business, right? Then their incentives are greater. And finally, private ownership, right? So because in the leverage restructuring, right, usually there will be a group of investor, they will buy out this company, right? And usually the company will go private, right? Will go delisted. So then when they go private, then they'll be monitored closely by private investors, right? So then the monitoring becomes better, right? So then the private firms managers have stronger incentives, right? So then the usual trick is, well, those private equity investors, they buy out the firm, improve the firm, they will make the firm go public again after a couple of years, right? Then they will exit from the firm. Simply they profit from the leverage restructuring, profit from the performance improvement. Another type of restructuring is called spin-off, right? Spin-off is usually creating a new company, right, but detaching part of the parent company's assets and operation, right? In our case, shares in the new companies are distributed to the parent company shareholder, and spin-offs allow investors to invest in just one part of the businesses. So the idea of spinning off is that because the company might be too diversified, right? It might become a gigantic company which is not very efficient. So in that case, by spinning these businesses off, management of the parent company can concentrate on its main activity. Right? So another type of spin-off, which is similar to spin-off but not exactly the same, it's called carve-outs. Right? Carve-outs are similar, except that the shares in the new company they are sold in a public offering. Right? So we can look at one example here. And also asset sales, right? Asset sales are basically, or divestitures basically try to sell part of one firm to another. For example, one study found that over 30% of assets acquired in a sample hostile takeovers was subsequently sold. Right? This is asset sale. In general, announcements of asset sales are good news for investors in a selling firm. And on average, the assets are employed more productively after the sale. Right? And now we're going to talk about privatization, right? So then we're going to talk about private equity and the bankruptcy, right? So basically, a privatization is the sale of a government-owned company to private investors, right? So there are three incentives to do so, right? For example, increase the efficiency, share ownership, and revenue for the government. In general, people believe that firms almost always become more efficient, financially healthy, and increase their capital investment spending after they go privatized, right? Essentially because government is usually bureaucratic, right? So which can create lots of inefficiency in the firm, right? So now let's look at private equity, right? So private equity, the kind of peak of private equity deals, right? For example, LBOs or leveraged buyout conducted by a private equity investor, the peak was like in the 2006 and 2007. Now let's look at what is the private equity, right? Private equity usually has two partnerships, right? One is called general partners, the other is called limited partners, right? So in the investment phase, the general partners put up 1% of the capital, right? They help organize these partnerships, right? Establish this partnership, right? But they don't put in lots of money, right? So the limited partners put in 99% of the capital, right? But what general partners do is that they charge management fee, right? They manage the partnership for the private equity investor, right? And then this partnership will be managed by general partner, right? And then they will use the money to invest in different company, right? Company 1, 2, 3, 4, 6. Right? And basically, maybe they will do a leverage buyout of company 1, right? So, and then the second phase is the payoff phase. In the payoff phase, general partners get carry interest of 20% of profits, right? Which is similar to like 20% performance fee in the hedge funds. Right? This gives general partner very strong incentive to manage the private equity partnership well. And the company that go to the second phase will go to IPO, right, in many cases, or they will be sold to another company. Right? Now in this phase, limited partners who put almost 99% of money in, right, they will get investment back, and then they will take the 80% of the rest of the profits. Right? In general partners set up and manage the partnership. Limited partners put up almost all of the money, right? So, and what are those limited partners, right? So they are institutional investors, such as pension funds, endowments, and insurance companies, right? What are the responsibility of general partners, right? They seek out companies to invest in, like venture capital or LBO funds, right? And this partnership agreement has actually limited term, right? The general partners get a management fee, essentially, right? This management fee is usually 1% or 2% of capital committed. and plus a carried interest in 20% of any benefits earned by the partnership. So this carried interest actually gives the general partner plenty of upside, right? 20%. And that's why it also gives the general partners incentive to take a risk, right? So venture capital funds, they take the risk inherent in startup company, right? So the buyout funds amplify the business risk with financial leverage, right? And in private equity partnerships, there is also no separation of ownership control, right? I mean, general partners, they own the firm, they also run the firm, right? That's why there's no free cash flow problem. Cash from the first round must be distributed to the investor. That's why there's no free cash flow there. So the popularity of private equity has also been linked to the cost and destruction of public ownership, right? Including the cost of dealing with 7 SOX, right, and other legal and regulatory requirements. So if you go private, then it avoids public interest short-termism and it makes it easier to invest for the long run, right? Because public shareholders, they're sometimes short-term oriented, they're sometimes myopic. They just focus on the short-term profits of the public company, right? And general partners, they usually have to find a way to cash out of the company, right, in the partner's portfolio. For example, one way to cash out is to push for one of the company to go IPO. Yeah? Also, they can sell the company to another company. So in this way, I mean, in some ways, the private equity partnerships are very similar to traditional, like a conglomerate company, right? Because private equity, they invested in, they bought actually lots of firms, right? So, and lots of firms, they're actually in different industries. So this is like a traditional conglomerate. So what is the traditional conglomerate, right? It's usually a widely diversified firm who can operate an internal capital market, right? So the free cash flow generated by divisions in mature industry, they can be channeled back to those divisions with plenty of profitable growth opportunity. Right? So which means free cash flow. So there could be transfer of cash, right, from division to division. So I mean, this could be an advantage, right? This can also be an issue. Yeah. Basically, this internal capital market, there'll be just combinations of central planning and intra-company bargaining, right? So division managers will try to bargain and they try to get a budgeting, right? So the problems with this internal capital market in a traditional conglomerate is that when the number of industry grows, there could be missed allocation, right? So I mean, when the number of industry grow, it suddenly becomes more complicated for the kind of the top managers to decide which industry to invest in, which industry to allocate their money to. Right? And also because the divisions, right, the divisions market values, they cannot be observed, right? That's why it is difficult to incentivize divisional manager. That's why there could be agency problem, right? Because divisional manager might not maximize the shareholder value, right? Might not even maximize the value of the company as a whole. Right? So that's why ownership of the conglomerate usually dispersed, not concentrated. Right? That's why the monitoring is bad. So this table summarizes the similarity and differences between private equity partnerships and conglomerates. Right? A private equity is well diversified and they usually invest in unrelated industry. Right? In a conglomerate, it is also well diversified. It is also investment in unrelated industry, but for the private equity fund, there is limited partnership. When the partnership expires, the portfolio company are forced to be sold. Right? But in the public conglomerate, there's no limit, right? And also in the private equity fund, there's no internal capital market, which is sometimes inefficient, right? There are no financial links or transfers between portfolio companies. Right? Whereas for a public conglomerate, there is the internal capital market. No? So in general, conglomerates, they buy another company in the another industry, right? And then they fix the problem of the company being bought, and then they hold the company as a part of the bigger company, right? Part of the division essentially. But differently, private equity investors, they buy the firm, they also buy different firms, right? But they fix the problem and they sell it, right? They sell it to another firm, or they push the company to go public. So by selling the firm, the private equity investor, they avoid the problem of managing the conglomerate and running the internal capital markets, right? Therefore, avoid those inefficiencies. So that's why they are both diversified, right? Private equity conglomerate, but the fund has no internal capital market, right? Which can cause inefficiency. And also the monitoring and the compensation of management also differs, right? The way you compensate for general partners is very different from you compensate for a divisional manager, right? Usually it's very difficult to compensate for a divisional manager. So each company is run in the separate businesses. The manager's compensation depends on their firm's market value in a trade sale IPO, right? This is for any private equity managers, right? So that's why you can see the ownership and control is clear. That's why the incentives are also better. So finally, we're going to talk about bankruptcy, right? So which is a very extreme form of restructuring. So in bankruptcy, some firms are forced to sell or reorganize by the onset of financial distress, right? And shareholders in general have to agree to the reorganization plan with their creditors or file for bankruptcy. Because when a firm goes bankrupt, right, we talked about earlier, right, who's the one to get a payment first? The creditors, right? So there are two articles for which one is called Chapter 7, right? Chapter 7 oversees the firm's debts and the dismemberment. Another article is called Chapter 11, right, which seeks to rejuvenate the firm, right? Rehabilitate the firm. So this Chapter 7 article or law is usually, like Chapter 7 bankruptcy protection, is usually filed by small firms. So the bankruptcy judge will appoint a trustee to close the firm down and auction the asset. The proceeds from the auction are used to pay off the creditors, right? Remember, creditors have the first right when a company goes bankrupt. And in that case, the queued creditors first get paid and then unsecured creditors. Right? And then after that, the court and the trustee get paid and then wages, right, for those employees. And then federal and state taxes and debts to government agency. This is the order of payment when a company goes bankrupt. Large public companies, they attempt to rehabilitate the business when failing to pay debts, right? So sometimes these companies will file for Chapter 11 to deal with bundles and labor contracts and lawsuits. The purpose of Chapter 11 is different from Chapter 7. Right? The purpose of Chapter 11 is to keep the firm alive and operating, right, while a plan of reorganization is worked out. In this reorganization plan, each class of the creditors will give up the claim in exchange for new security or a mixture of new security or cash. Right? Basically, in this reorg plan, the creditors will propose a new capital structure. Right? So this capital structure will satisfy the creditors, of course, right? And then allow the firm to solve the business problem. Right? But to satisfy the creditor, this is the most important thing. So whenever a payment is due to creditors, management checks the value of the equity. Right? So that's why if the value is positive, the firm makes the payment. If the value is valueless, the firm defaults on its debt and it files for bankruptcy. This we also talk about. We talk about the default risk, right? Expected bankruptcy cost. So if the assets of the bankrupt firm can be put to better use elsewhere, right, the firm then will liquidate it and the proceeds will be used to pay off the creditors, right? Otherwise, the creditors become the new owners, right? And then the firm continues to operate. So lots of things affect the efficiency of Chapter 11, right? For example, if the company kept on going, kept on being operated, there could be tax loss carry forwards, right? Simply speaking, if you earn negative profits for like consecutive 2 years, right, you might get a tax break. You might have to pay less tax. That's why operating the firm forward might be kind of one of the tax incentives for continuing the firm. Second, when a company is reorganized, the claimants are often paid off with a mixture of cash and security. So that's why they're not exactly paid at a fair value. Right? And also in this process, even if shareholders they want to push for reorganization, the senior creditors may press for liquidation. Right? They want to press for liquidation because they know that they will be get paid first. Right? But if the company continues to operate, they might not be get paid. Right? So, on the other hand, the shareholders and junior creditors, right, who get paid actually later in the process, right? There's a queue of different parties, right, who will get paid after the company goes bankrupt. Right? That's why here, shareholders and the junior creditors will be advantages for them to wait, right? They'll prefer reorganization and they will try to delay. Right? So there are some reasons, the relevance of Chapter 11. You can take a look. And finally, here is a brief introduction of the governance and corporate control around the world, right? So you can take a look at the graphs. They're pretty self-containing, right? So just comparing the holding of equity, holding bonds across different countries. And then this is so much for this week.